Hello there, my name is Keith Hiscock, CEO of Hardman, and I'm joined on this edition of Hardman Talks by our life sciences analyst, Martin Hall. Martin has had a distinguished career in the city, analysing life science companies since 1987. Martin is responsible for the Hardman Co Healthcare Index, which has been running since 2009. The main function of this is to chart the course of life science investments over the long term. Now, Martin, in January, you published a review of healthcare performance in calendar 2023. Can you run through the salient details, please?
Indeed, Keith. For the second year running, and actually quite unusual for healthcare, the sector index declined by 3.7% in 2023, and it underperformed both the FTSE 100 and the FT all-share indices. Now, our index covers currently 52 companies, and last year only 15 of those saw an increase in their share prices, and 4 of those were attributable to M&A activity where they were bought out by a competitor. So apart from the general economic influences, which have made institutions more risk averse, there was a common knowledge that several companies in the sector were in need of additional working capital. So share prices were marked down in anticipation of equity raises.
Martin, thank you for that. It's well known that the industry is capital intensive. So what's changed?
Well, when I started as an analyst 36 years ago, there were many more institutional investors, and nearly every one of those had either a specialist healthcare team or a specialist small cap team, and actually usually both. Extensive consolidation within the investment community, increased regulation and risk assessment associated with pension funds, and a vast increase in wealth being invested has resulted in a small number of groups with enormous funds under management. So consequently, their interest in small cap companies has evaporated, and they prefer to use alternative investment funds for their involvement in this space. Literally today, only a handful of institutional investors still have specialist healthcare analysts. So when a small cap healthcare company needs a capital increase, their options with the institutional investors are very limited. Where institutional investors are prepared to get involved, they really quite often want their pound of flesh, i.e. they will only support an issue if it's deeply discounted. And this often wipes out existing shareholders, which are usually the retail investors.
Martin, that final comment is really interesting. Can you provide us with some examples, please?
Well, in the report, we show 2 examples. First, Yourgene was desperate for cash at the very end of 2022, and it raised new capital at 0.3 pence per share. Now, that was a 94% discount to the 6-month average closing price prior to that announcement. The stock already was trending down because the market realized that it had a need for more capital. Existing shareholders were only offered a small opportunity to participate. Of course, the institutions that drove that issue made a very good return when Yourgene was bought out only a few months later by Novosit for 0.5 pence per share. The second example we show is Allergy Therapeutics, where its 2 major shareholders underwrote a £40 million issue at 1p per share, and that compares with a price of 6.25p ahead of the announcement, and actually looking back over a 12-month period, down from about 30p. This time, however, existing shareholders were given a proper opportunity to participate, so it was purely up to them whether they did or not. The desperate need for working capital, coupled with the lack of support, also forced some companies to try what we call alternative financing approaches. However, these nearly always end up being detrimental to shareholder value. A really good example was Gene Drive PLC, which accepted a drawdown from facility from a company called Riverfort of up to £5 million. Now, at the time of the announcement, the share price was 32p, but on each drawdown, Riverfort was issued with shares and warrants. But actually, Riverfort wasn't interested in being a long-term shareholder in the company, and so only wanted to get its money back. So what it did was sell each tranche of shares in the market, and that just forced the share price ever lower. So we saw this continual downward spiral, such that to date, Gene Drive has drawn down only 3.5 million of the 5 million facility, and this has so far diluted shareholders by 54% and left the shares trading around 5 pence, giving it a market capitalization of about £4.5 million.
Okay, so has the need for capital caused any awkward situations to arise?
Yeah, unfortunately, the answer is yes. Reneuron has tried unsuccessfully to raise new capital twice within the space of 12 months. The shortage of cash led the board to request the suspension of shares in February and the appointment of administrators in March. So very disappointing. Also, one of Hardman's clients, Advanced Oncotherapy, has been seeking a capital injection for over a year. And while progress has been made, its shares have currently remained suspended, and that's been the case for about 15 months now.
You highlighted in the report a number of companies that you thought would need new capital in 2024. How's that turned out so far?
Well, to date, I've recorded 12 healthcare companies tapping the market for new capital, and they've raised between them £102 million. The median discount has actually been quite modest at 15.7%, but I should point out that the range is very, very high, from some coming in as a premium and some at quite big discounts. However, I am expecting several more, and at this point in time, I'm aware of at least 10 companies that will need more cash in the next 6 months. Also, this year, there has been another worrying trend from a London market perspective. 3 companies to date, C4X Discovery, RedX Pharma, and eTherapeutics, all unhappy with their valuation afforded them by the market, have announced a decision to be taken private. Now, this has forced retail shareholders to sell their shares in the market, often crystallizing a material loss, which has reduced valuations even further, or they have the choice to hold on to a minority interest in a private company. But in the case of eTherapeutics, the company intends to relist its shares in the US, where it expects to get a better valuation and have exposure to far larger pools of capital that are more willing to take a longer term view. Listing in the US has been done successfully in the past, and a good example is Silence Therapeutics. And that company has raised $176 million in the past 2 years and seen its valuation triple since listing in the US. And I think that's way beyond what it could ever have achieved in London. Also, Immunocore has also successfully listed in the United States. But in contrast, Oxford Nanopore, which decided to list in London around the same time as Immunocore, both in 2021, has seen its shares drop 80%. And this is largely because the company is still several years from becoming EBITDA positive, which appears to be less important for US investors. But that is also the case of being EBITDA negative for Immunocore, and that's seen an increase in its valuation. Moving listings to the US is very topical at the moment, and there are a number of both FTSE 100 and FTSE 350 companies stating their intention to change their primary listings on account of valuations. In the life sciences sector, apart from the obvious three majors, AstraZeneca, Glaxo, and Smith and Nephew, Convatec and Indivior are also both high on the list for moving, and of course, both of them already report in US dollars. The loss of these five companies would leave the London market really floundering.
So, Martin, what's your take-home message?
Well, when we just look back over a couple of years, 3 years, the response to COVID, there are some absolutely great technologies in the UK, but institutional investors are failing this exceptional industry, which has given them good returns in the past, by not supporting them properly today. Given the valuations afforded by the market, often well below the cost needed to get a company where it is today, it is not surprising to see more and more companies looking towards the United States. Now, a really good example on which Hardman Company has recently published is Tissue Regenix. The company has two specialist tissue technologies, both of which have regulatory approval in the United States and in some other territories. Barriers to entry are really enormous because the business involves the sourcing, processing, and regulation of human donor tissue. So the major players run a mile and are quite happy to leave these obstacles to a niche player like Tissue Regenix and simply rely on the product supply and commercial agreements with these specialist providers, which are few and far between. So Tissue Regenix has grown sales by more than 20% in each of the past 6-month periods and is now EBITDA positive and cash generative. But despite this, the company has a market capitalization of only $55 million compared to the $150 million it has spent getting to where it is today. Now, obviously, we believe that the market will eventually wake up to this high quality opportunity. But the real take-home message is unless things change and quickly, there will not be a healthcare sector in London in a few years' time.
Martin, thank you for sharing those thoughts with us. You'll find more detail on our note, which is available for free on our website, hardmanco.com. As always, thank you for watching. Please don't forget to like this interview and join in the conversation wherever you're listening. See you next time.